You can buy the dream in one sentence. Build a big box store, stock it, open the doors, and watch $100 million a year pass through the registers. Here is the real version. One of America's largest retail empires, 3,500 stores, 355,000 employees, a company that once accounted for roughly 1% of the entire U.S. economy, collapsed into bankruptcy court in under 12 years, not because it sold the wrong products, but because the math underneath the building stopped working. Here is what this actually costs. Start with land. A single Walmart-scale supercenter needs 10 to 20 acres near a major road, and in a mid-size metro that land alone runs $6 to $8 million before a shovel touches it. Then the building itself. A supercenter averages roughly 182,000 square feet. At current big box construction rates of around $100 to $120 per square foot, that's $18 to $22 million in steel, concrete, and refrigeration infrastructure alone. Add site work, grading, drainage, parking for 1,000 cars, utility hookups for a building that runs refrigeration cases 24 hours a day, $4 million. Add permitting, environmental review, zoning variances, and engineering, the fees nobody puts in the pitch deck. $2 to $3 million, and that's before a single objection from a neighborhood association adds months of carrying costs. Fixtures and equipment, shelving, refrigeration units, point-of-sale systems, security infrastructure, $6 million. Now the part that surprises almost everyone, opening inventory. A store this size stocks upward of 140,000 individual items. Getting shelves full on day one costs $10 to $12 million in merchandise alone. Money spent before a single customer walks in. Add signage and exterior branding, parking lot lighting, pylon signs, pharmacy and grocery department build-outs. $600,000. Add pre-opening labor, hiring and training roughly 300 associates before a single register is live, plus a grand opening marketing push to pull traffic away from every competitor within a 10-mile radius. $1.5 million. Total entry cost, land through opening day, roughly $52 million. That's before payroll, before marketing budgets for year one, before you've sold a single item. Once the doors are open, the costs don't slow down, they compound weekly. Merchandise cost, what accountants call cost of goods sold, exists because every item on the shelf has to be bought before it can be sold, and it eats the largest share of every dollar that comes in. About 73 cents of every revenue dollar, based on Walmart's own reported gross margin of 27.2% last fiscal year. Labor is next. It exists because a 182,000 square foot store doesn't stock, scan, or clean itself. A supercenter runs on roughly 300 associates. At an average wage near $18.25 an hour, working an average 30-hour week, that's close to $8.5 million a year in wages alone, before payroll tax and benefits push the real number past $10.6 million. Depreciation exists because a building and its refrigeration systems wear out, and accounting rules require spreading that cost over time instead of absorbing it all in year one. On the $52 million build, that's roughly $3.2 million a year. Utilities exist because refrigeration cases run around the clock, 7 days a week, regardless of foot traffic. For a building the size of 3 football fields, that's about $750,000 annually. Shrinkage exists because inventory disappears, to theft, to administrative error, to vendor fraud, between the loading dock and the register. It hit 1.68% of revenue industry-wide in 2024, the highest rate the National Retail Federation had recorded in over a decade. On a $100 million store, that's $1.69 million a year, gone, with no transaction behind it. Card processing fees exist because most of that revenue never touches cash. It moves through card networks that take a cut on the way through. At roughly 2% of revenue, that's another $2 million. Insurance, maintenance, and repairs exist because a building this size floods, breaks, and gets sued. $1.3 million. Corporate overhead, supply chain, IT systems, marketing allocation exists because no single store operates in isolation. It's plugged into a distribution network that costs money to run. That adds another $3 million. Total annual operating cost, before a single dollar of profit, approximately $95.8 million. And that's assuming nothing goes wrong. Here's where the money actually comes from. It's not one big number. It's millions of small ones. The average shopper spends about $54 on 13 items per visit and makes roughly 67 trips a year across a household's Walmart-related shopping. Multiply small transactions by enough daily foot traffic across 51 open weeks a year, and it adds up to Walmart's U.S. segment total, $462.4 billion in net sales last fiscal year across 4,605 stores. Divide it out, and the average store does about $100.4 million in annual revenue, built $54 at a time. Subtract the $95.8 million in costs from Section 2, and you're left with roughly $4.6 million in operating profit on a $100 million business. That's an operating margin of 4.6 to 5.2%. For every $100 that crosses the register, about $5 becomes profit. The other 95 are gone before you see a cent. That thin margin is stable, right up until one variable moves, and one variable always moves. Big box retail runs on debt, construction loans, inventory financing, real estate leverage. Between March 2022 and July 2023, the Federal Reserve raised its benchmark rate from near zero to 5.25 to 5.50%, the fastest tightening cycle in over 4 decades. For a retailer carrying construction and inventory debt, that kind of move doesn't just raise a line item. It can add hundreds of thousands of dollars in annual interest cost per store, arriving at the exact moment consumers, squeezed by the same rate hikes, start trading down and buying less. Grocery and household staples hold up in a downturn. Discretionary categories like electronics and apparel, the higher margin items that actually pad a store's profit, do not. This is not a new pattern. Retailers who expanded aggressively on cheap credit during low-rate years have historically been the first to buckle when rates reset, because the debt service was sized for a world that no longer exists. Margin that was already thin at 5% doesn't survive that kind of squeeze without a plan. There's a company that lived this exact story at a scale big enough to make headlines for a decade. In 2006, it ran over 3,500 stores and employed 355,000 people. Today, it barely exists. That company is Sears. In 2005, hedge fund manager Eddie Lampert engineered an $11 billion merger between Sears and Kmart, betting that combining two struggling discounters would create a stronger competitor. At its peak in 2012, the combined company operated more than 4,000 stores. Then the spiral began. Instead of reinvesting in stores or e-commerce, the company spent heavily on stock buybacks, spun off profitable divisions like Land's End in 2014, and sold off owned brands including Craftsman in 2017. 2 decades earlier, Sears had already discontinued its general merchandise catalog in 1993, a business generating $3.3 billion in sales but losing $175 million a year to run, cutting 50,000 jobs in the process. Amazon launched the following year. The timing, in hindsight, was one of the most consequential misses in retail history. Revenue, which had topped $50 billion a decade earlier, fell to $16.7 billion in its final full fiscal year, with losses in 15 of the previous 16 quarters. In October 2018, Sears Holdings filed for Chapter 11 bankruptcy with just 687 stores and 68,000 workers left, a fraction of its 2006 size. The company's pension plans, covering 90,000 workers and retirees, carried a $1.5 billion shortfall the federal government had to absorb. Lampert's own hedge fund bought roughly 400 surviving stores out of bankruptcy for $5.2 billion in 2019, a real estate holding company wearing a retailer's name. This was not bad management in the sense of one wrong decision. This was a financial structure, leverage, buybacks, and underinvestment, running headlong into a business model with a 5% margin for error. Here's a cost that never appears on a first-year projection: self-checkout shrink. Industry data shows staff checkout lanes lose about 0.2% of revenue to theft and error. Self-checkout lanes lose 3.5%, nearly 18 times higher. Walk through the transaction. A customer scans a $40 card at self-checkout, skips one item, and walks out. On paper, that was a sale. The register shows revenue, the shelf shows a gap, and the projection counted both as normal. In reality, once you allocate the store's blended 1.68% shrink rate weighted towards self-checkout traffic, a meaningful share of every self-checkout transaction is a paper profit and a real loss. Multiply that across a lane running hundreds of transactions a day, thousands of stores, and a full calendar year, and self-checkout, the very feature installed to cut labor costs by roughly 1 cashier per shift, quietly gives a chunk of those savings back through the door it opened for loss. There is another cost growing faster than almost any other line item on the sheet, and it isn't theft. Returns. Retailers projected 16.9% of 2024 sales would come back through the door, up from 14.5% in 2023, a jump in a single year. On a $100 million store, that's nearly $17 million in merchandise returned annually, much of it damaged, discounted, or unsellable at full price by the time it's processed. The National Retail Federation estimates the average retailer absorbs $145 million in returns for every $1 billion in sales. Layer onto that the systemic risk, product liability and premises liability claims. A single serious injury lawsuit, employment class action, or supply chain contamination event can produce a settlement running into the tens of millions of dollars, an amount that can erase an entire year's profit from dozens of stores in one legal filing. Wage and hour class actions, ADO accessibility suits, and slip-and-fall claims are not rare exceptions in this industry. They are a recurring, budgeted line item for every national chain's legal department. This is not a cost you plan monthly. It's a cost you insure against, set aside reserves for, and hope never arrives in the wrong quarter. Some things get better at scale. Buying power improves. A chain ordering by the truckload negotiates lower unit costs than any single store ever could. Distribution gets cheaper per unit once a regional warehouse network exists. Marketing cost per store shrinks as brand recognition spreads, but other things get harder. Shrink rises with foot traffic and self-checkout adoption. Labor complexity multiplies across thousands of local wage laws and scheduling regulations, each requiring its own compliance system. Compliance costs, food safety, pharmacy regulation, employment law, scale faster than revenue does, because each new state or municipality adds its own rulebook on top of the last. And every store added to the network is one more potential lawsuit, one more potential shrink event, one more building that can flood or lose power. At a certain size, a retailer stops being a store operator and becomes a logistics and real estate company that happens to sell groceries. The stores themselves become almost secondary to the supply chain, the trucking network, and the owned real estate underneath them. That is a completely different business, with a completely different risk profile than the one described in the entry cost math from Section 1. Optimistic scenario. Revenue holds at $100.4 million. Shrink stays at the 1.68% national average. No lawsuits, no equipment failures, interest rates stay flat. Net operating profit, roughly $4.6 million. An honest 4.6% margin. Realistic scenario. One refrigeration system fails mid-summer and needs full replacement. $500,000, plus the spoiled inventory that went with it. Shrink creeps to 2.4% as self-checkout usage grows past projections. An extra $760,000 in losses beyond the baseline. A premises liability claim, the kind that arrives with no warning, settles for $2 million. Interest expense rises $400,000 on floating rate construction debt after a single rate cycle. Recalculate. Operating profit falls to roughly $940,000, a margin under 1%, on a business that still did $100 million in revenue. The difference between those two scenarios is one equipment failure, one lawsuit, and one bad rate cycle. None of these are exotic disasters. All three happen to someone in this industry every single week. Roughly 20% of new retail businesses close within their first year, and about half don't make it past 5, according to long-running Census Bureau and Small Business Administration data. The primary cause is almost never poor product selection. It's cash flow. Too much debt-funded expansion. Too much capital tied up in slow-moving inventory. Not enough cushion for the one bad event. The retailers that last share 5 specific habits. They keep inventory turning fast, so markdowns never pile up into a cash crisis the way they did for Sears in its final years. They own real estate instead of leasing at rates that rise every renewal cycle, giving them a hard asset to borrow against instead of a recurring liability. They fund growth from operating cash flow, not debt, avoiding the buyback trap that hollowed out Sears's balance sheet while its stores went unrenovated. They run loss prevention programs that treat shrink as a monthly metric tracked store by store, not an annual surprise discovered during year-end inventory, and they reinvest a fixed percentage of profit into infrastructure, distribution, refrigeration, technology, every single year, in good years and bad, instead of treating capital spending as the first thing to cut when a quarter looks soft. The dream was one sentence: build it, stock it, open the doors, collect the money. The real version is a $52 million entry ticket followed by a margin so thin that one lawsuit, one rate hike, or one bad quarter of shrink can cut annual profit by 80%. Retail at this scale isn't a product business. It's a risk management business that happens to sell groceries. If numbers like these are what you actually want from this channel, the subscribe button is right there.